Hi everyone, today we will present to you about finance for small and medium-sized entities. This is the list of our group members. We will talk about introduction on SMEs, financing needs of SMEs, financing problems for SMEs, measures to ease the financing problem of SMEs, source of financing for SMEs, and financial impact of different sources of finance for SMEs. Firstly, introduction on SMEs. SMEs are small and medium-sized entities that need to be registered with Suruhan Jaya Syarikat Malaysia (SSM). However, there are some entities that don't need to be registered with SSM, which are entities that are publicly listed on the main board and subsidiaries of publicly listed companies on the main board, multinational corporation MNCs, government-linked company JLC, syarikat masa kewangan diberbadakan MPD, and state-owned enterprise. SME's definition is based on total sales turnover in a year or the number of full-time employees, whichever is lower. On the screen now is the sales turnover and number of employees of every size for manufacturing sector, and this is for service and other sector.
The next one is financing needs of SME. First of all, to start a business, starting a company often requires owners to secure financing. In this situation, it may need some time before the business to generate enough cash from sales to bear the cost. Business finance provides needs to determine the best way to approach startup financing. Thus, the owner can use this information to request a loan to start a business. The second one is increased working capital. Working capital is important in helping the business in terms of solvency. SME with high solvency encourage financial institutions to approve the loan. Usually, working capital is calculated based on cash, assets that can easily be converted into cash, and expenses that is due within a year. The third one is performance management. Business finance formulas help owners and managers measure cash inflows, return on major investment, and the amount of time needed to earn back the spent capital. Consequently, financial analysis allows business owners to use quantitative method to measure a company's performance.
Let's move on to the next part. What is the financing problem for SMEs? When compared to the financing options available to major corporations or organizations, access to financing for SMEs is frequently challenging or difficult. Financing is frequently a key issue for SMEs. These are the major financing problems for SMEs. First one, we have lack of asset for collateral, and next, lack of proven track record, and lastly, not paying bills on time. As for lack of asset for collateral, collateral refers to a security or guarantee for the lenders in the form of an asset or property. The failure of the SME to meet the bank's collateral requirement could be due to the fact that they do not have any assets that they can put forward as collateral. Most of the time, if SMEs does not have collateral, the banks are hesitant to lend them money. Next, we have lack of proven track record. Small businesses must maintain track of all the financial transactions, which they frequently do with the assistance of bookkeeper. Inaccurately documenting transactions can have a negative feedback loop, affecting monthly cash flow and other financial reporting. SMEs must keep track record of all the transactions in order to prepare financial statements. Financial statements are important to the financial institution because they show revenue, expenses, and debts all of the SMEs. Based on the financial statement, the banks will decide whether to grant a loan or credit to the business. And lastly, not paying bills on time. While a single late payment may be excused, remitting payments late on a regular basis can be costly to a small firm. A bad credit score can be caused by default payment, late payment, court judgment, or simply lack of financial history. Credit worthiness is determined by the business credit score. Financial institution will consider the business credit score before approving the financing application. SMEs must monitor their credit score before submitting the SME's financing application.
Next up, we are going to look at the measures to ease the financing problems of SMEs. First of all, why does the government help finance SMEs? Government is keen to support innovation and is keen to support the growth of SMEs as this will boost employment in the country. Financial aids to finance SMEs in Malaysia. The Malaysian government has introduced many financial aids for Malaysian SMEs. Most of the aids were introduced to help SMEs that are badly affected by the COVID-19 pandemic. Now, let's look at some of the examples of financial aids introduced by the Malaysian government. First and foremost, supporting new startup launches. What is it about? SMEs who register and start their operation from 1st of July 2020 until 31st of December 2021 can claim tax rebates up to RM20,000 per year. The objective of this aid is to encourage the establishment of new SMEs in Malaysia. Secondly, Targeted Loan Repayment Assistance or known as TRA. This aid is to help SMEs with a loan amount up to RM150,000 as they can either defer monthly installment for 3 months or reduce monthly installment by 50% for 6 months. What is the objective of this aid? It is to delay loan repayment for SMEs whose income were affected by the pandemic. This is crucial because many SMEs are struggling to repay their loan since their income are facing a downfall during the pandemic. The next one is boosting online business. What is it about? Local businesses and individuals with or without business registration can receive e-commerce and e-payment onboarding training, seller subsidy and sales support. The objective of this incentive is to facilitate more SMEs to adopt e-commerce and e-payment for their businesses and expand their market outreach. This is also important because in the new norm, we are encouraged to minimize physical contact to prevent the virus from spreading. Therefore, e-commerce platform is the best way for SMEs to continue their business. And of course, e-payments such as online banking and e-wallets are essential to ease payment and at the same time reduce physical contact. This can also be called as cashless transactions. Moving on to the next one, which is SME Digitization Grant. So, what is it about? SMEs that qualify for subscription to digitization services will be provided a grant up to RM5,000. Each grant is limited to only one application per SME. And for SMEs in manufacturing and services sectors, there is a grant called Smart Automation Grant (SAG) to digitize parts of the business operations. The objective of this grant is to assist SME in adopting digitization services in daily business operation. This is also quite similar to the previous one. As we are living in the modern era, almost everything is digitalized. But as we know, digitalizing our business, especially for SMEs, is quite costly. So that is why the government introduced this grant to help SME to digitalize their business. Last but not least, Wage Subsidy Program WSP 3.0. This aid is basically provided for employers. Employers will receive a subsidy of RM600 per employees earning below RM4,000 per month. What is the objective of this subsidy? It is to help business cope with payroll difficulties caused by the movement control order. During this pandemic, many employers are also struggling to pay their employees. That is why the government provides this subsidy to help ease the burden of employers of SMEs.
What is sources of financing? Factoring, a financial transaction between a business owner and a third party that provides instant cash to the former in exchange for the account receivable of the business. This finance is only short-term and is often more expensive than an overdraft. The business angel. A business angel is a wealthy individual willing to take the risk of investing in SMEs. These individuals are not common. Once a business angel is interested, they can become very useful to the SME. This is because they will often have great business sense themselves and are likely to have many useful contacts. Bank loan. Banks have a special department dedicated to providing loans to small companies. To get a loan from a bank, companies have to qualify for bank's minimum criteria. Trade credit. SMEs can take credit from their supplier in short terms. If the suppliers are larger companies who have identified them as a potentially risky SME, the ability to stretch the credit period may be limited. Personal. Using personal savings or receive personal funds from family members, friends, also some type of potential sources of business funds. They may be willing to accept a lower return than many others as their motivation to invest is not purely financial. The financial impact of different sources of finance for SMEs. Factoring. The pros is company gets to extend payment term with confidence. The cons is the cost is higher than the cost of other types of financial fund. The business angel. Pros: gain money for fun quickly. Potential to raise huge amount of money in short amount of time. The investors may offer advice and help. Cons: owner must give away part of the business to the investors. Investors may have a different vision for the business than the owner does. Bank loan. Pros: easy and quick to access. Can get a significant amount of money at one time. Cons: have to pay for the interest. Difficult for a new business to apply for the loan. Trade credit. Pros: access to supplies without immediate payment. No interest. Cons: only for short term, credit must be paid off quickly, usually in small amounts of money. Personal. Pros: quick and convenient. Doesn't require borrowing money. No interest payments to make. Cons: the owner might not have enough saving or may need the cash for personal use. Money may be lost if the business fails.
Finally, these are the references that we referred to when making this video. So that is all for this video. We hope that we can deliver some information about small and medium-sized entities with you. Thank you for watching.